So go to chapter 12, accounting for depreciation and disposal of non-current assets. We already know what non-current assets are. Assets that can last more than a year, right? Land, machinery, and so on. So when we talk about depreciation, here depreciation is an estimate of the loss in value of a non-current asset over its expected working life. So what happens after the usage of a non-current asset in terms of its value is what we call depreciation, because it's going to lose value.
Yes.
So because of that, then there's depreciation. So how do we go about calculating depreciation? So before we talk about calculating depreciation, there's capital expenditure. That means you have spent on purchasing this non-current asset. So what is capital expenditure? I wrote, this is the purchase of a non-current asset. So the cost of a non-current asset is not charged as an expense in the year of purchase, as it benefits the business for several years. So you won't see, whenever you purchase a non-current asset, you won't see it as an expenses for that year, because it will spread over the years of its benefit or of its usage. Do you understand? So if you buy, let's say you buy a motor vehicle now. Buying a motor vehicle now, it's not going to be an expenses for this year. The expenses starts through the years you continue to use that car. Do you understand? So that means there will be provision for depreciation for that car. The provision for depreciation starts, and depreciation for that car starts when you continue to use it. It's spread across numbers of years you use the car. So the first year, it cannot be an expenses. So it's not going to be recorded in your income statement account. I think it's clear. So what are the causes of depreciation? We have physical deterioration, economic reasons, passage of time, and depletion. So what is physical deterioration? This is the result of wear and tear due to the normal usage of the non-current assets. So when you continue to use a car, it will continue to wear and tear because you are using it. It's not going to remain, it's not going to be the same way. Even if you maintain it, it's still not going to be the same way. So this is what we call physical deterioration. Also, sometimes rainfall, when rain falls on assets, it could deteriorate. It could rust. So these are what we call physical deterioration. Is it clear?
Yes.
So, economic reasons. So the non-current assets may become obsolete. What is obsolete? It does not meet the needs of the business anymore. There are new ones produced. You understand? Look at what I wrote. I said the non-current asset may become obsolete as newer and more efficient assets are now available. So this one, the old one, no longer meets the needs of the business. You know, sometimes you have some things, some assets, some cars are done. You dump them. Why? Because you have a new one. So it does not meet your needs anymore. So that's what we call obsolete, economic reason. Is it clear? The third reason why we have depreciation is passage of time. So this is where a non-current asset has a fixed life of a set number of years. You've set the numbers of your example, leasing. Okay, this house or this machine I will lease it for you for 5 years. So that means after 5 years, it stops working for you. It has depreciated. That's an example of passage of time. The time has gone for this lease or for the usage of this product or asset. And the last one is depletion. This is where the worth of the asset reduces as value is taken from it. You know, like the oil wells, the mines. As soon as you take whatever you need from those land, the value drops. But when those precious stones are still there, it has value. So as soon as you take those precious stones away from them, the value stops. The land depreciates. Do you understand? That's what we call depletion. Any questions about it? Great. Now, how do we calculate depreciation? There are different factors that have to put into consideration before selecting a depreciation method. One, how long is the asset expected to last? So, how long do you expect these assets to last? It could also determine the method of calculation you use. Two, how much will the asset be sold for when it is put up for use? So how much are you going to sell this asset at the end of your usage? Three, how can the benefit from the use of the asset be measured? Are you going to be able to measure the benefits? So if not, then you might not be able to. If it's possible, then you need to use the arithmetic method of depreciation. So what are the methods we have? So we have the straight line method, reducing balance method, and revaluation method. So for the straight line method, this is where the same amount of depreciation is charged each year. So for the straight line method, you're going to use the same depreciation method for the whole year. So if the depreciation is for 4 years, you use the same depreciation charge for the 4 years. Do you understand what I mean by straight line method? You use the same amount of depreciation for the whole year 1, year 2, year 3, and year 4. So what is the formula? It is cost of assets divided by the number of expected years. Are you with me?
Yeah.
So we have a question. They said, Kativa's financial year ends on 30 June. On July 23, she purchased fixture costing 25,000. That's the cost of the assets, and paid by check. She estimated that she would be able to use the fixture for 4 years. Calculate the annual depreciation charge as an amount of money, as a percentage. There are two things here. So first, they said we should calculate the annual depreciation as the amount. So we want to know the amount for each year. And the second one is the percentage charge on depreciation. So the formula for the amount is cost of assets divided by the number of years. So it will be 25,000 divided by the number of years. It will give us the amount of money charged on depreciation, which is 25,000 divided by 4 years. So that means 6,250 for each year. Now, to calculate the percentage, it will be the amount for each year divided by the total cost times 100 for percentage. The amount for each year divided by the total cost of that asset, of the non-current asset, times 100. So the amount was 6,250 divided by 25,000 times 100. So the depreciation as a percentage is 25%. Is it clear?
Yeah.
Then we have what we call residual value. For the residual value, this is the value of a non-current asset at the end of the useful life. So if after 4 years that I used this asset, I want to sell it for 3,000, for example. So that means if I have to calculate the amount of depreciation, I have to deduct the value I'm going to sell, the amount I'm going to sell it from the cost, from the amount of depreciation. Do you understand?
Yeah.
So let's see what I wrote here. I said where it is estimated that the asset will have some value at the end of its working life, this must be included in the calculation. Then the straight line method becomes cost of asset minus residual value divided by the number of expected years. Do you get what I'm saying here?
Yeah.
Because we have the amount we are going to sell it after using it. So you take it away from the original cost divided by the number of years. So here they said on 1 July 23, Kavita purchased fixtures costing 25,000 and paid by check. She estimated that she would be able to use the fixtures for 4 years and then be able to sell them for 3 years for $3,000. So $3,000 is the residual value. Now they said calculate the annual depreciation charge as an amount. We want to know the annual depreciation charge, number 1, and 2, as an amount, as a percentage, based on the original cost. So the annual depreciation charge for the amount, it will be cost of assets minus residual value divided by the number of years. So the cost of assets is 25,000 minus residual value, which is 3,000, divided by 4, the number of years. We need the annual.
Yeah.
So the annual amount is 22,000 divided by 4, which is 5,500 yearly.
Yeah.
That's for the depreciation per year is $5,500. Now, as a percentage, it will be the annual amount divided by the total cost, the cost of the non-current asset times 100. So the annual amount is now 5,500 divided by the cost of that asset, which is 25,000 times 100. So we have 22%. Is straight line method clear?
Yeah.
You have any question about it? Okay.